Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets and over 80 alternative strategy mutual funds, representing 80% of the AUM of the alternative strategy mutual fund market.
Hello, I'm Mike Kell, Senior Vice President, Program Management and Business Development here at AI Insights, and I'm joined by my counterpart, Laura Sexton, Senior Director, Program Management, to discuss our most recent private placement industry report for March 2020. As everyone could imagine, the COVID-19 coronavirus situation is a significant impact right now on all aspects of investing in both the public and the private markets. Transactions are slowing across the private placement categories, and valuations, which, as most of you are aware, require transactions in order to validate, or help with those actual valuations, which means that if you have a lower transaction volume happening, then those valuations that are taking place might be less reliable or obviously more difficult to obtain. There's certainly a lot more that it's going to come out of the markets with the COVID-19 situation, and it's something that fully expect AI Insight to bring forward, from a discussion perspective, what we're seeing on a going forward basis, as you're going to see across the entire industry. But Laura, suffice it to say, let's have a discussion around our current overall private placement coverage, both on a year-to-date basis as well as what we've seen in March 2020.
Sure. Yep. So in March, we added 15 new private placements to our coverage, which was just below the last couple of months, but still well over last year. So in terms of new fund coverage, we're about 30% above last year, and this is, of course, as of the end of March. And then the aggregate target raise, we're seeing kind of bigger funds. The aggregate target raise was about 36% over last year's level. So, still moving along and still growing, at least through March. And the industry, as like last year, continues to be led by the real estate focused categories, including the 1031s, real estate LLCs and LPs, and some of the opportunity zone funds. So as of April 1st, we actually cover 178 private placements currently raising capital, and those funds have an aggregate raise of $17.6 billion and an aggregate reported raise of $8.8 billion, or about 50% of targets so far in terms of the ones that are currently raising capital. The average size of the funds in our coverage is $99.1 million, and there's a huge range. This ranges from $3.5 million all the way up to $2.5 billion. A pretty big range in terms of the funds that we report on. 13 private placements closed in March, and those funds reported that they raised approximately 70% of their target, and they had been on the market for an average of 311 days. So, still moving along in March. I'll just touch a little bit on some of those real estate categories. 1031s, the last couple of years were, the biggest category within private placements. That trend has continued at least through March here. So we had 8 new 1031s added to our coverage in March. The sector did slow a little bit, but definitely, as overall private placements, those are still up year over year in terms of both new fund coverage and aggregate target raise. Big focus on multifamily still. So the last couple months we saw a little bit more diversification, but last month was very focused on multifamily, with 7 of the 8 DSTs added last month focused on multifamily, and still, overall sector allocation remains pretty focused on multifamily in terms of the funds raising capital at this point. Average year one cash flow is 5.31%. It's up a little bit from the prior month. Average LTV is around the 60% range, and that's been kind of the average over the last couple of years, so kind of remained steady in terms of the average LTV. And so 1031s closed in March, and 27 have closed so far in 2020. So these funds tend to close out once they've raised their target. So the funds that have closed this year were on the market for an average of 274 days, so a little, less than a year, and reported that they raised 100% of their target. So we've got we have actually, as of April 1st, we had one new 1031 coming soon to our coverage. And let's move on a little bit to the non-1031 real estate, another area where we've historically focused quite a bit, and that's seen quite a bit of growth as well. So this would be real estate programs, including LLCs and LPs outside of 1031s. So we added 3 of those to our platform in March, and we've added 9 so far year to date. The ones in March, we had 2 multifamily funds, again, continued kind of focus on multifamily, and then we had 1 mortgage loan fund for providing funding for development and construction. We cover 54 non-1031 real estate private placements, and those funds have an aggregate target raise of $6.1 billion, and have reported that they've raised about 25% of their target. And actually, we 13 non-1031 funds, real estate funds, have closed in 2020, including 7 that closed in March. And those funds that closed were on the market for an average of 445 days. So these are on for a little bit longer than the 1031s. And those reported that they raised an average of approximately 56% of their target. So they tend to be on the market for a little bit longer, maybe don't raise quite as much as the 1031s. But that's what we've seen so far this year. We had about 3 of them coming soon that will be added to our coverage this month. And then in terms of opportunity zone funds, I mean, this was a big category last year. Obviously, a relatively new component to our coverage and new to the private placement sector. We saw a lot of those added last year. Continuing to see some new coverage, we saw 3 opportunity zone funds added to our coverage in March, and we've got another one coming soon. And these funds, actually, these were bigger funds, in the $250 to $500 million range. Last year, we saw quite a few smaller, kind of more targeted funds. So this year, we're seeing some larger blind pool funds that are, just looking to raise capital to invest in properties across the United States. A couple of them have, sort of geographic focuses, but their kind of overall mandate is to acquire throughout the United States. And then we also saw 1 new sponsor enter the market in this space in March. So we cover 21 of the funds that are raising capital right now. And the category, like I said, is relatively new. So we've only seen 4 opportunity zone funds that have closed. So it's a little tough to get an idea of, the actual trends. But interestingly, the funds that have closed in 2020 reported that they raised 100% of their target, and they were on the market for an average of 212 days. So, clearly not as much data to provide yet, but, the ones that we do have data on seem to have raised their target and, kind of similar to the 1031s in terms of their overall raise and the time that they're on the market. So I think those are some of the primary trends that we were seeing in the private placement world, at least as of the end of March for now. So I'll hand it back over to you, Mike.
Good. Hey, thanks, Laura. And I think it's kind of interesting when, as Laura mentioned, what we've seen here at AI Insight from a private placement coverage perspective is absolutely substantial growth year over year through Q1. And that's certainly exciting. I mean, that's a great thing for the industry to see to see those numbers. But obviously, really, in the United States, I mean, we didn't see significant impact necessarily from COVID until certainly later in Q1. So certainly, I think it's reasonable to expect that we, from an overall coverage perspective, will start seeing much more impact from COVID really in Q2. We're certainly seeing some programs suspend their offerings and things of that nature, as you could imagine, more so on the public side of things at this point. But we have already seen some of this in early Q2. We expect to see more of it in Q2. It's going to be interesting to see to the level to which we will see that impact. But Q1, again, as Laura mentioned, was substantial increase year over year. So Laura, let's shift gears a little bit, and I think knowing what's going on in the world right now, maybe let's spend a little bit of time drilling down from a general research perspective into some of the sectors of strategy, that kind of aspect of things, some considerations with what's going on and maybe expectations in the near term in somewhat distant future, if you don't mind.
Yeah, sure. And I think I'll focus a little first on real estate, since that's, again, sort of what our private placement sector at least has kind of been focused on the real estate program. So, I mean, obviously, COVID-19 is going to have immediate and long-term impacts on commercial real estate, already having big impacts on many areas. But, in looking into some of the data, Real Capital Analytics, I think you mentioned this, they have shown that transaction volumes are already down more than 50% across Asia, and are already down 20% in the Americas, which are still kind of months behind Asia in terms of the impact. So you'd expect, less transaction volume and kind of continued declines in transaction in the Americas if we are following the trends that are happening in Asia. And I think, social distancing, obviously, we all know, I mean, that's keeping people inside, and so clearly impacting retail and hospitality. I mean, I don't know about you guys, but driving around, when you do leave the house, which is rare, but driving around and seeing completely empty shopping malls and shopping centers and things like that, and hotels is quite crazy. I mean, it's just something I never thought we'd see, really. So already clearly, the biggest impact and most immediate impact is on retail and hospitality. And so CBRE had some metrics out there. So the key metric for analyzing hotel financial health, which is revenue per available room, or RevPAR, is forecast to decline by 30% in 2020, with a contraction of more than 60% in Q2 alone. And I mean, before this, it was expected to grow by 3 to 4% in 2020. It's slowed over the last couple of years. It was up, in the high single digits the last few years. It was expected to slow a little bit in 2020, but now it's forecast to decline by 37% in 2020. And again, that contraction of more than 60% in Q2 alone is crazy. I mean, and demand for hotel rooms is forecast to decline by 30% in 2020. ADRs are expected to decline 11%. So, I mean, there's no hotel funds out there with this in their worst case scenario analysis. This is just not something. I mean, it's not something anybody has in their scenario. I mean, usually you see a base case, a worst case, and a best case, and this is way worse than the worst case. So, it's really going to come down to, for the hotels, how they're financed, their cash flow. They're going to be working closely with their lenders and looking at. I mean, they'll probably end up triggering a lot of covenants with those RevPAR numbers. And so it's going to come down to, hotel by hotel, property by property, and how they're going to be working with their lenders and investors on, kind of getting through this, because it is expected to be the worst quarter hotels have ever seen. So immediate impacts there, and potentially longer term too, just because of kind of, fears and things like that, human kind of, how things develop over the next months and years. I mean, it's going to be a little difficult for everyone to sort of want to travel a lot again, and so the hotel industry experts are saying there could be not just this immediate, but a longer term, and especially what I think is interesting is the thought that in some of the higher the areas like New York City, Manhattan, which is obviously kind of one of the epicenters of this. Those hotels are, kind of key properties for a lot of the hotel companies. And now, the thought is that maybe there won't be quite so much demand there as people are sort of staying away from more densely populated areas. You could see some longer-term impacts on some of those key properties. So hotels, again, kind of going to be property by property and how things go. Office real estate, I think, is another thing. It's already experienced pretty significant shifts after the Great Recession, and even now may see longer-term impacts in addition to short-term here. A Real Capital Analytics actually said that this kind of forced working from home may actually break down some of the cultural resistance to remote work in certain markets. And you've seen this even from business leaders saying that, they were resistant to working from home, and now, that's kind of being forced upon them. They're all kind of getting used to it, seeing how it works. People are still being productive. It may actually cause a huge shift, and for office owners may be even worse actually in the longer term, just because people are going to get used to working from home and see that it's, maybe not quite as difficult as it was once thought. So, potentially some pretty significant longer term impacts for office, and so the lending side's also kind of come to a halt. I think again, this is going to be property by property. Commercial real estate lending's come to a halt. Cushman & Wakefield said the banks are not issuing any new loans and to any significant effect anytime soon, including commercial real estate. And debt funds, a lot of the debt funds out there rely on bank lines to support lending, so they may be out for a little while as well, which on the flip side may be good for some of the funds that this may be where some of the private debt funds that don't rely on lines can step in, and so there's the thought that private debt funds that have dry powder on their books, money that they need to spend, might actually kind of benefit here, and kind of step in to take over with the bank, some of the lending that the banks can't do right now, and might fill the gaps, might be helpful to kind of keep assets going, keep things from defaulting or going into foreclosure. It's just going to come at a slightly higher cost because the private lenders tend to be, higher cost than the bank. So that's just some of the things going on, some of the kind of ramifications, I think, on the, a lot more obviously going on, but sort of some of the kind of key research findings that I found in reviewing the commercial real estate sector, if that helps.
Yeah, thanks, Laura. It does. Certainly, I mean, there's a lot going on in the world. I think that it's interesting that there's still opportunities out there. I think it depends on which side you look at. As Laura mentioned, some of these private equity funds and the private debt funds, the amount of dry powder that they have is at somewhat historic levels. Mm-hmm. So I think that there's certainly opportunities to be had there. I'm both the debt and equity side of things. I think it's just a matter of different types of opportunities maybe than we've seen before, because I think from an investor perspective, you immediately think of the risks involved in any type of those investments, because if the debt funds are going in to finance something that these large banks won't, then inherently it appears that they could be at higher risk to the end investor. So that's really where that manager selection comes into play. Really looking at these particular managers that have been through. I mean, obviously, this is certainly different than the Great Recession, and different than other situations that we've had in the past. So there's economic aspects of this entire thing that are really uncharted waters. But it's still, either way, it still comes down just another example of why manager selection is so important. And then obviously you get into the equity side of things as well. I mean, we can all relate. They're small to mid-sized businesses right now. The number of them that are in a less than great situation, as you could imagine. They need backing. I mean, these are good companies, and it's not just mom and pop shops down the street. I mean, these are substantial firms with substantial revenue that have been hit as well, that are certainly at risk. So hopefully there's a happy medium between private equities, funds coming in supporting them to help them become successful, rather than the kind of the horror story headlines that you're seeing as far as the private equity funds that are more vultures in nature, that are coming to simply take advantage of an otherwise great business opportunity. So hopefully that there's a happy balance there that comes out of this. Suffice it to say, again, just not to kick the horse while it's down, but just another plug for manager selection at a time like this. Over communication, whether you're on the sponsor, the fund manager side of things, whether you're the intermediary the advisor, the client. I mean, communication certainly is key, Laura. So as always, thank you very much for these great insights. The last plug I'll put is the hedge fund side of things. You'll see more from AI Insight coming out, kind of looking at hedging strategies in a mutual fund wrapper. But suffice it to say that you also are reading headlines right now about hedge funds and how they are, maybe performing better now that you have an increased volatility going on, whereas, in relation to the extended bull market that we had seen. But I think it's important to understand the underlying strategies within the hedge funds and why, for example, some of those that are more short than long or have the ability to capture arbitrage and things of that nature are going to outperform more so than those that are more long in nature. So again, just another plug for not only the manager selection, but truly understanding the underlying strategy. So if you are shifting, maybe some investments now or looking at different things, it's really important to understand not just the structure that you're investing in, but really the underlying strategy as well, so that it does perform to your needs from a portfolio aspect. So again, we'll talk about that more on the alternative mutual fund side of things. But Laura, thanks again for all of your insight as always. Thank you to the subscribers for supporting industry reports every month. They're in our platform. We look forward to you getting in, reading much more about it, fine details, broken out by individual category. And then certainly we're excited for the next report to come out. Every month we'll do these podcasts, and maybe more so now than ever, important to really see what's going on in the private placement world. So thanks again, Laura, and thanks again to the subscribers.